Hello and welcome to Compounding Curiosity. I'm your host Kalani Scarrett, and this podcast is all about compounding your curiosity alongside my own through thoughtful interviews with interesting guests. For transcripts and detailed show notes, check out the links in the description. Hopefully you're as keen as me to learn something new, so let's get stuck in. My guest today is Aaron Pek. Aaron is the author of Value Investing Substack and was previously an equity fund manager, overseeing both the Malaysian and Asia ex-Japan portfolio with assets under management of around 500 million ringgit, which is about 100 million US dollars. He is currently setting up his own equity research outfit. And in this conversation, we cover value investing, Malaysia and the ASEAN growth story, and adding value while networking. So I hope you enjoy my conversation with Aaron Pek. Aaron, thank you so much for being here. But I think just maybe to get started, I'd love to hear maybe your early influences and why you got into investing, how it all started for you.
Sure. My dad used to be an entrepreneur, and I've always wanted to follow in his footsteps. But, as time went on, I realized that business was a really high risk, high reward endeavor. So, you could do very well overnight, and you could also do very badly overnight. So for somebody like me, I felt it didn't meet my risk tolerances, my personal risk tolerance. But I was still interested in business as a concept. So when I discovered value investing, I realized eventually that basically it was investing in businesses, right? Because you just think about what the average large cap CEO, how the average large cap CEO thinks. It's very similar to how a value investor thinks, right? The strategic concepts and philosophies are all there. I mean, most large cap CEOs don't get into the weeds and move things around, right? So it hooked me because you were also able to manage risk through diversification. And as a result, it was the best of both worlds for me, both from the risk side as well as the reward.
In terms of value investing theory and sort of principles, like what's been your personal interpretation of Graham and Buffett's popular value investing principles?
Basically, the way I understand value investing, to me, can be boiled down to two quotes, right, by the value investing legends. The first is by George Soros. So he has a quote that says that it's not whether you're right or wrong that's important, but rather how much you make if you're right and how much you lose if you're wrong. So the wisdom behind this quote can be seen when you observe the realities of a stock market. So the way we tend to judge our own performance is through the lens of hindsight, right? With the benefit of hindsight. So we tend to look back and we judge ourselves, assuming that we had the benefit of hindsight from the future. Whereas when you are making the investment decision, right, for the far future, you tend not to have the benefit of hindsight. In fact, you never will have the benefit of hindsight. So this concept of being able to identify the future through superior analysis, I feel is a flawed one because for the simple reason that the future doesn't exist yet, right? And when you're talking about the macro environment, anything in the world can happen. Just think about COVID, right? It was a complete black swan event. And yet it affects your portfolio. So I don't think that it is ideal to use this DCF approach, right? The traditional contemporary finance approach to valuation of stocks. Rather, it is the best we can do is make guesses about the future, right? So basically, you understand the landscape well enough, the investing landscape well enough, so that you can sort of make guesses about the possible future outcomes, maybe 10 to 20 of them, right? And you have a gut feel based on your familiarity with the landscape of what are the likelihoods of each of those outcomes, as well as the potential impact of those outcomes. So no matter what happens, you sort of prepared, right? And you know what action to take almost immediately because you've already done the work. So this brings us back to George Soros' quote, which is, it doesn't matter whether you're right or wrong that matters, but what you make if you're right or what you lose if you're wrong. It's basically the same philosophy as history is written by the victors, right? Where we start from the present as a reference point and interpret the past using the present. Whereas when you were in the past and you're trying to identify the present, that's not the way it works, isn't it? You can't actually, right, with true superior analysis, identify the future for the simple reason that the future hasn't existed yet and there are way too many moving parts as far as the stock market is concerned. So the best you can really do is just try to guess the future, right? Doesn't matter whether you're right or wrong, but you do have a very clear idea of the potential outcomes and their potential impact. So it's what you make if you're right and what you lose if you're wrong. That, I would say, is the first philosophy. And the second philosophy can be encapsulated in Benjamin Graham's quote, which is an investment operation is something which promises the safety of principal as well as an adequate return. So note how he uses the words safety of principal, right? The key words safety of principal as well as adequate return. This is in direct contrast to how most equity investors think, right? Which is maximum return. And oftentimes we don't even really think about safety of principal, right? And also note what other asset class actually fulfills this criteria of the safety of principal and adequate return. It's very akin to bonds, isn't it? So when you're buying a bond, you tend to care more about the safety of principal than the return, right? As long as the return is adequate, you're fine with it, right? So I think at least that's my personal interpretation of what Graham meant from this quote in the context of buying stocks. So he was trying to find a stock which had the same risk reward as a bond, right? You could have a higher return, but you could have higher risk, but you better have high return as well, right? It's not a Dogecoin kind of scenario, to the moon kind of scenario, right? So the real key component is safety of principal, because as you know, most value investors, they always go on and on about margin of safety, right? And if you actually take a walk down history, you'll note that a lot of Graham's as well as Buffett's approach to investing prioritizes safety of principal. Just very quickly give you one example. Most people, when they look at Graham's habit of investing in net stocks, right, what they tend to focus on is that because he is buying things at below working capital, he's able to easily liquidate them and realize a return, right, in a very assured way. But what I think not enough people spend time on, right, on this narrative is that assuming that for whatever reason he fails to achieve his objective of liquidating the working capital, because he bought the stock at such a depressed price, in all likelihood he will be able to resell those shares, right, at zero loss to another smart investor, right? For the simple reason that he picked the stocks up at below working capital, right? So he has secured his downside and he is happy with the upside. And I think that's something that value investing really does emphasize on versus contemporary finance, where contemporary finance really focuses a lot on the upside with very little focus on the downside. The typical sell-side report has a risk section of about 3 paragraphs, while value investing really focuses to the downside and only gives the same, right, flip consideration to the upside.
But in terms of the principles of value investing, is there anything you typically disagree with? Is there anything that you find isn't quite current, or you differ in your investing thoughts compared to classic theory?
I don't think the problem is with the value investing crowd, right? The problem is with the contemporary finance's interpretation of value investing. Because what contemporary finance defines as value investing is actually the value factor, where you're investing in low earnings multiple stocks, whether it's price PE ratio, PB ratio, right? So that's what Graham used to do, right, in his time. And people grab a lot about how in this day and age where everyone has a Bloomberg terminal, that's no longer feasible, which is true. But the first principles don't necessarily rely on investing in low earnings multiple stock. Because think about what value investing means, right? So my personal interpretation of it is that value investing is simply buying something for less than it's worth, right? When it's a low earnings multiple stock, you're buying a stock for less than you think it's worth. If it's a high earnings multiple stock like Amazon, you're buying it because you think it's less than it's worth, right? The future cash flows far exceed even the high earnings multiple that it's commanding. It doesn't necessarily have to be the value factor or the growth factor. There's no such dichotomy. Charlie Munger actually has said before that all intelligent investing is value investing, right? You could even extend this to a house or a car or getting married to somebody, right? If you want to go to the extremes. All intelligent investing where you're getting a good ROI on it, right? With a sufficient margin of safety is considered value investing. So I don't think that it's really an issue of are you investing in low multiple stocks? Are you investing in high multiple stocks? Are you investing in dividend stocks, right? It's really about the principles of having safety of principle and adequate return.
Yeah. So you spoke about all investing is value investing. And I think along similar lines for me, how I think about it is, well, everything is risk. When someone says, oh, the stock market's too risky or individual stocks are too risky, so is driving down the street. Yeah. So how do you approach risk and value investing? Is it just trying to minimize risk through getting those quality businesses at a fair price?
Sure. So many value investors have actually described risk as the permanent loss of capital, right? Which aligns with Graham's quote about safety of principle. But obviously, with all things that are good, they eventually become cliche and lose their original meaning. So here's how I interpret risk myself. Think about how risk is uncertainty that has been measured, right? That's the textbook definition of risk. So uncertainty is basically risk that cannot be measured or has not been measured yet. And that's really what we are worried about, right? Because think about COVID, right? When is COVID? Let's say you were to buy an airline stock. When is COVID going to end, right? That's an uncertainty because you can't measure it and therefore you can't model it, correct? As far as valuations are concerned. So I talk about risk. What I see is that we're trying to guarantee an outcome. So basically, risk reduction to me means that we try to eliminate uncertainty or minimize uncertainty as much as possible by through the elimination or mitigation of risk and uncertainty, we can gain a more certain visibility of the return. So for instance, if you were afraid of COVID, you might hedge yourself with a put option, right? That's reducing risk. So that's also also in the context of avoiding the permanent loss of capital, right? I think this is a more intuitive concept to follow than simply asking somebody to follow some kind of rote formula, right, with regards to risk. And risk is definitely not volatility in my view. So I think the reason why contemporary finance considers volatility as risk is because drawdowns do matter in the professional world, right? Whether you're dealing with a retail investor or an institutional investor, people just hate drawdowns. So in the context of drawdowns, yes, volatility can be interpreted as risk, right? But for us value investors, the best bargains tend to be when stocks have fallen. And when you're trying to catch a falling knife, it can fall further, right? So volatility kind of works against us as a metric of risk. And I align with a lot with what most other value investors think in terms of risk, which is permanent loss of capital, as opposed to temporary loss of capital.
Yeah. So you mentioned drawdowns and the large volatility, which probably leads into emotions in investing. So how do you deal with the emotions that come with investing large drawdowns, and how do you go about, managing that?
Sure. So I'm going to draw a quote from Game of Thrones. Right? There's a man called Peter Baelish, right? Or his nickname being Littlefinger, one of the characters in Game of Thrones. And in one particular scene, he was speaking to his protege, whose name was Sansa. And he was teaching her about how to approach war, right? And his quote was, see everything in your mind, right? Every possible series of events happening all at once. See everything in your mind. Look at things this way and nothing will ever surprise you. So I think it also aligns back with George Soros' quote about it's not whether you're right or wrong that matters. It's how much you make if you're right and how much you lose if you're wrong. So what he's doing is thinking about probable outcomes, right? Many different probable outcomes as opposed to trying to identify a single certain outcome, right? And he's thinking in terms of probabilities as well as impacts. So this allows him to envision all possible broad outcomes that might happen, such that the moment they happen, he doesn't panic. He already has a backup plan, right? And he's just exercising a plan from his playbook, right? And this allows you to stay in control, right? In fact, in terms of your emotional state, because you already have prepared for the outcome, right? So George Soros is actually very well known for being a master at cutting losses. The reason why I think so is because of this, right? He has already prepared for all possible outcomes. And the moment something happens, he just takes action based on his plan. And if something falls out of his radar, for instance, a black swan event like COVID, he just cut the loss because it's not within his framework and therefore not within his control. The new information, which he could not have expected by virtue of it being a black swan event, occurs, he would just take the loss and move on, right? So, obviously, this is not an answer about how do you avoid losses, but it does provide a very a strong foundation for how to stay in control, right, of your emotional state.
Yeah, no, I love that answer. Maybe to transition more to the Malaysia side of equities, what are some overall themes and trends that you see that are positive for equities in Malaysia? Like, what are you excited about as an investor in Malaysia?
So I think that Malaysia is it actually has a very interesting story to tell. It's going to I feel that it's going to be one of the biggest beneficiaries of the ASEAN growth story. The ASEAN growth story is basically the China growth story today, right? So basically, once every 30 to 50 years, the center of the manufacturing base, global manufacturing center, shifts across the world. So think about, in the post-war period, it was in America. And then later on, it was in Japan, right? And to some extent, South Korea and Taiwan. And for the past, call it 25 years, it was in China. So the reason is because manufacturing tends to be involved with low value add items, right? I mean, we're referring to the bulk of manufacturing, which is low value add items. And you tend to want to have your low value add items being manufactured in places with low cost, right? For instance, China 20 years ago, land was cheap and labor was plentiful. So compared to setting up a base of operations in America, you would imagine that you will have to deal with much higher labor costs and even union costs and stuff like that, right? So the thing about China is that right now it's experiencing what America was experiencing 30 years ago, which is that as it graduates into a first world economy, the labor pool starts to become more expensive. And therefore, it makes sense for businesses to shift their base of operations as far as manufacturing is concerned to a different region which is cheaper. And where is the most likely place to go to? It's ASEAN. Firstly, because of its proximity to China. And secondly, because compared to other similarly developed economic blocs, ASEAN is really the most stable, politically speaking, right? Obviously, you can draw a comparison to the first world countries. ASEAN is nowhere near that level. But compared to places like Latin America or Russia or Africa, we're the best, right? So that's why Vietnam has been attracting a lot of FDI, because it's literally bordering China. And businesses find it so easy to just shift manufacturing operations to Vietnam, where the labor pool is a lot cheaper. The narrative is that in roughly 30 years' time, the rest of ASEAN will also benefit from the same Vietnam growth story. So we call this ASEAN growth story. And eventually businesses will also seek to shift their locations beyond Vietnam into the rest of ASEAN. And here's where I think Malaysia has a very interesting outlook, because think about the polity makeup of ASEAN. I think that, so you have places like Myanmar, Laos, Cambodia, Indonesia, Singapore and Malaysia, and the Philippines. Of these countries, I think the next beneficiary after Vietnam would most likely be Singapore, because first of all, it has sanctity of rule of law, as well as good low corporate tax rates and a good business environment. But there's only so much land in Singapore, and I don't think there's enough land literally. If you covered every square inch of Singapore with factories, there will still not be enough land to build factories for businesses, global businesses. So they will inevitably be thinking, after Singapore, where next? Where in ASEAN next? And I think that next beneficiary will be Malaysia, right? The main reason being that the Malaysian population consists of 25% Chinese, right? And I know some may say that, oh, this may sound a bit, racially discriminatory, but that's not where I'm coming from. It's simply the fact that businessmen tend to prefer familiarity. You just imagine if you were doing business with an Indonesian and you accidentally step on his toes for whatever cultural reason, and you lose your entire FDI, right? Possibly billions of dollars. So that's just not something you want to risk, right? You'd rather just deal with somebody who you are familiar with, even at the expense of being seen as racial preference, right? Because that really doesn't matter at the end of the day for business, right? So in Malaysia, you already have certain urban areas which have pockets of Chinese population that are thriving with business. I think what happens is that you will see, after Chinese businesses have saturated Vietnam and Singapore, they will start considering Malaysia as the next base of manufacturing operations. And you can actually see the Malaysian government making adjustments to accommodate this process for the far future. They're partnering with the Chinese government. They're doing handshake agreements. they're developing the border between Singapore and Malaysia, which is the state of Johor, and they're involved in certain infrastructure projects under the One Belt One Road. So compare this to the other states of ASEAN, right? Indonesia is perhaps the country who gets the most attention in terms of FDI. Indonesia unfortunately suffers from a significant lack of bureaucracy. So getting anything done needs to be probably involves a bribe of some sort. And they also have a very strong socio-economic identity in terms of socialism, right? The president is a proud socialist. Sorry, is it? Yeah, it's the president. He's a proud socialist. And they tend to, the socialist identity tends to bleed into business, right? So in around 2014, many Malaysian listed companies actually tried to take advantage of the Indonesian growth story by virtue of the fact that it has the biggest Muslim population, and I think it's the fourth largest population in the world, right, in terms of countries. So they went there, and I would say 90% of them came back licking their wounds. Right? One of the differences in business culture is that they're very cutthroat and they're very protectionist. So Indonesian businesses, as you can imagine in most emerging countries, tend to be very large, right, and very consolidated. So when a foreign entrant comes in, they'll just dump the price and make you bleed until you exit, right? It's the typical cutthroat strategy. It's not very conducive, right, to business for foreign business to enter. And whereas Malaysia doesn't suffer from that perspective. Think about Vietnam. It's a communist government, which means you're always going to be worrying that the government can nationalize your business at any time, right? If it becomes too attractive. Myanmar is just simply not ready to accept foreign businesses. Neither are Laos and Cambodia, which basically do not even register on the global map. Philippines is also, right, it's basically like a Mexican ASEAN Mexico, where they have, huge drug wars and a flamboyant Trump-style president. So I'm not saying that Malaysia is great, right, compared to the rest of the world, but compared to the rest of ASEAN, it's basically like the United States. And also maybe I'll just very shortly add one last thing, which is that we have very strong levels of bureaucracy, right? Which means that applying for business permits, applying for export permits, these kind of things, they're very straightforward, right? And also our institutions are strong. We have very strong regulators. I would say that our regulators in the form of capital market regulators, right? The central bank, the Securities Commission, as well as the boards, they are first world level, right? On par with the likes of the US. And also, despite a lot of political volatility, right, as evidenced by the constant changing of the guard at the political administration level, the social makeup of the polity is not really conducive to radical upheaval. The likes of Thailand, where you have the whole polity split between the yellow shirts and the red shirts, right? So in Malaysia, neither the heavily conservative rural base nor the left-leaning, the progressive urban grassroots base are kingmakers in any particular Malaysian general election. The kingmakers tend to be the centrist Malays in the Malay heartlands, right, who don't particularly have strong leanings to the left or right. You can have it's the same for the US, right? You can have very strong right-wing base. You can have a very strong left-wing political base. But at the end of the day, it really comes down to the people on the fence, right? That determines the outcome of the election. So while you can have a lot of political volatility in Malaysian politics, there is really very little risk of social upheaval, right, due to this political risk.
Yeah, so you mentioned some of the risks for other ASEAN countries, but when talking about Malaysia, what do you think is the risk that Malaysia doesn't live up to their ASEAN growth story? What has to happen for them not to achieve their potential, do you think?
So I think that Malaysia it's not all hunky-dory in Malaysia. So for instance, they have very high debt to GDP for an emerging country. But to be fair, I think most emerging countries right now have the same problem. So Malaysia's debt to GDP, according to Fitch ratings, is around 77% if you include contingencies and guarantees. And that's a staggeringly high amount for an emerging nation which does not have control over printing fiat currency, right? Full control of it. And also about 20% of its government revenue is still dependent on oil sources, which can be very volatile as compared to very stable tax sources. So, absent the ASEAN growth story, which is an exogenous factor that is outside of the control of the Malaysian government, I really question how they could potentially maintain their historical growth level of, call it 4 to 5% GDP growth, because there's a lot of headwinds working against them. So for instance, over the past 20 years, since the Asian financial crisis in 1997, we have not even had a single budget surplus. It has been consistent budget deficits, which means we have been borrowing for growth. And that has been the main contributor to our roughly 4 to 5% average GDP growth over the years. So think about absent that debt, right? It's probably going to drop closer to 3%. And here's the thing, we can't really borrow anymore, right? So if you've been following Malaysian news, financial news, you actually will realize that, it has been allowing withdrawals from its pension funds. So normally a pension fund's purpose is to prepare for your retirement, right? Before they release the funds to you. But now they're allowing us, people like me, to withdraw early, right? In order to stimulate the economy. So it's well within the confines of unconventional monetary policy, the likes of QE, right? Keeping in mind that for Malaysia, QE is not really an option. This kind of unconventional monetary policy only happens because our debt levels are way too high, and the government just simply does not have the capacity to borrow more to further stimulate the economy. Kind of like at reaching some sort of debt ceiling, right? That unlike the US, we can't just raise into perpetuity. So as a result, I think there are a lot of headwinds, right? The Malaysian urban polity is not incorrect to feel concerned, right? In the absence of the ASEAN growth story. So assuming this ASEAN growth story materializes, I think that all this will just be wiped away, because it's like a disruption, the entire industry gets taken along with it, but for the positive. But as far as what is within Malaysia's own control, I think there's a lot more that can be done.
Yeah, no, I love it. In terms of foreigners looking to invest in Malaysia or who might be new to it, I know you've spoken previously about the makeup of the Malaysian index being heavily skewed towards key sectors like banking, utilities, and telecom. So could you just expand on that maybe and highlight some key things that someone should know before they start investing in Malaysia, and maybe what they can expect if they invest in an index or something like that?
So from my observation of the habits of foreign investors in Malaysia, I think the biggest mistake you can make is investing in the Malaysian index, because like you mentioned, it's heavily weighted just towards a few key sectors, right? Banking, telecoms, and utilities. Very similarly to how the S&P 500 is skewed towards big tech. So these sectors tend not to be growth sectors. And if you've been observing KLCI, which is our S&P 500 equivalent index, there is simply no growth, right? I think the average growth of the KLCI over the last 2 decades is on par with a fixed deposit in Malaysia, right? Something like 3 or 4%. It's really, really low. If you were to look at the KLCI, obviously the natural conclusion is that there is no growth in Malaysia. It's a failed state or something. Whereas so this is the first mistake. The second mistake I think you can make is investing in only the constituents of the KLCI, right? So you may not buy the whole KLCM, but you only invest in the big banks. You only invest in the big telecoms, the big utilities, or even some of the other less key constituents. When you do that, you're basically also suffering from the same issue, right, to a lesser extent. Because what you're doing is buying the most visible stocks, right, which all the foreign investors are buying, as well as the domestic investors. So you can imagine that the share price would tend to be trading around fair value, right? And keeping in mind that the public shareholder does not make money from the economics of the business itself. He makes money from the difference between those economics and the price he acquires the shares at. So if the price is high enough, it doesn't matter how good the economics of the business is, right? You still won't make much money. Whereas you also are exposing yourself to downside risk. My personal recommendation to all foreign investors is to look at small mid-cap space in Malaysia. There are tons, literally tons of businesses in the small and mid-cap space in Malaysia which are really well run, right? And exemplify the same level of stewardship as well as compared to the US companies. Right? Obviously, by virtue of Malaysia being an emerging market, you will get bad apples here and there, but you also get good pears, right, or good oranges. So I'm not saying that the entire Malaysian small mid-cap space is filled with these good examples, but there are certainly enough of them. If you go to my blog, valueinvesting.substack.com, you will see some of my favorite ideas there, which are In Nature, which is the body shop franchisee in Malaysia, Hibiscus, an upstream oil and gas brownfield operator, which doesn't employ much debt, AirAsia, which I'm sure most of you know about. So some of these stocks are trading at super depressed prices because of external environments that are not within the control of the company. And arguably, some do have risk, but they are definitely good ideas worth exploring, not exclusively because they have very good business economics, but for a simple reason that their prices are trading at higher, super depressed levels. So you can make the same dollar in these stocks, these Malaysian small mid-cap stocks, as you can arguably from a Facebook and Amazon, right? For the simple reason that there's no competition. No one is looking at them. So just think about it, compare it to an undercovered stock in a micro cap in the US. It's very similar. And also, if you were to visit my interview on the Asian Century Stocks blog with Michael Rizzo, who, by the way, is a phenomenal analyst, you see that I actually, there's a breakdown of my investment thought process about the Malaysian small mid-cap space, as well as a very attractive, the stock I like the most now, right, to quote Warren Buffett, which is Berjaya Corporation. So I won't go into detail here, but I actually did an interview with, a recent interview with a bunch of guys in Malaysia, where I go into detail about why I like Berjaya Corp. So feel free to visit there.
Yeah, our links will be in the description. So that's Finance in Real Life podcast, so FIRL podcast.
Yeah. So it'll be in the Fire podcast, which I think Kalani wouldn't mind including. And
I'll link in the description.
I go into a lot of detail about first of all AirAsia, second of all Berjaya Corporation, and third of all the macro environment in Malaysia. So do feel free to check it out. And if you want to reach out to me on LinkedIn for questions, that's fine as well.
For sure. To move into my closing round of questions, what's an undervalued life experience that you think university age students don't give weight to? Like, what's an underrated skill and experience that you think they should have?
Okay, I would say that one would be don't follow the mainstream, right? Keep asking why. So, alright, contrary to common sense, right? Sometimes they say common sense is the least common sense. What's popular in the mainstream isn't necessarily the most correct thing. And if you actually go beyond the mainstream by, for instance, reading value investing books, learning about history, you will actually get the sense that there's a lot more to the world than what you hear in the news, right? Or from rumors on Facebook. So that will actually help to inform you about the way the world works, and as well as bring you more peace and happiness in your personal life, because you have your mental models are more aligned with what's actually happening in reality, right? As opposed to being told something and the real world actually going against that framework. Definitely be curious. I think that curiosity killed the cat, but it enlightened the human being. So that's one. The second one I would advise you is in terms of career experience. I do think the networking is very important, which is, I think, what a lot of people also share with me. The way to build a network, right, is to just start somewhere, right, somewhere small, and just build on it. Because as you know, the network effect is compounding in nature. So you get to know one person, and he knows someone else, right, who may be able to help you, and that person knows someone else who may be able to help you even more. So don't worry about not having a network, right? So don't worry about not having a robust network from the beginning, right? Just start somewhere and just slowly compound the network, right, over time. Eventually you get to a stage where you know enough people that if you're looking for a new job, you can just give them a call and ask them, hey, do you have a vacancy available? That kind of thing, right? And also with regards to networking, I would like to stress that networking is not about what's in it for you, right? A lot of people tend to think that they go to networking events, they give out their business cards, and they say, they're always going there with the goal of what's in it for me, right? Whether it's a job or connections or money, right? Whereas I think many respectable networkers, right, gurus you can call them, actually suggest the flip side, which is network with the idea that you're doing it for them. You're always asking yourself the question, what's in it for the other party, right? What value are you contributing? Are you adding to that person's life? Someone important who may be able to extend you a job offer one day, be out of politeness, extend 1 minute of your time with you. But if they see that you're only doing it for yourself and there's nothing in it for them, in all likelihood, they're just going to politely excuse themselves, right? The same way that you politely entered their lives. Whereas if in that 1 minute elevator pitch, you could actually, rather than going on an elevator pitch about yourself, right? For instance, saying, hey, I'm working in Goldman Sachs. I do this. You say, hey, I'm working in Goldman Sachs. I can do this for you. I can make money for you, right? In that 30 seconds or 1 minute where he's obliged to be polite to you, you communicate the fact that you are valuable to him. You can make money for him, or even if you're a fresh graduate, you offer some kind of value add to him, right? He is going to be more interested to keep the conversation going beyond a minute, right? And most people are nice, right? You very rarely come across the sociopath who, out of principle, just does not want to extend a few minutes to be nice to you. So in that time when they're nice, just show them also that you can be of economic benefit to them, right? And that's how you build a network, because then they have an incentive to reach out to you again. In the end of the day, it's all business. It also aligns with the concept of marketing, right? Where in a business, you can have a very good product, but you also need to have a very good sales team, right? Or a marketing operation. Networking is really the marketing arm of your career, right? Where whether you're an IT programmer, whether you're an investor, whether you're an equity analyst or a fixed income analyst, that's the core business of your career. But networking is of the marketing, the sales element of your career, right? And this is not to say that the sales element is the only element, right? Some people think they can get ahead in this field just through people skills. I'm not saying that it's impossible, but in equity analysis, particularly, and fund management, it does involve a lot of technical skill. So you can get so far with just people skills, but eventually you're going to bump up against the guys who are good at both, right? And I would say that you do need to pay attention to your technical skills as well. But definitely also do not silo yourself into the technical aspect, right? Do pay attention to networking. It will do wonders for your career.
Yeah. No, I love that because, if you put enough value out into the world without expecting anything back, eventually it sort of just happens to return in spades. Like, it's funny how it all works, eh?
Yeah, at the end of the day, it's business, right?
And final question, what's your plans, man? Like, so what areas are you most curious about going forward? What's the plan for the next 5 to 10 years? Where are you going?
So I'm actually starting an independent equity research outfit. It's a value investing sell-side research outfit catered towards the global value investor, whether retail or institutional, who is interested in participating in the Malaysian growth story. I almost feel a sense of obligation to bring these stocks, right, these investment gems to the awareness of the global investing community, because it is just a travesty that these treasures are not spotted, right? People tend to think about stock markets in terms of the efficient market hypothesis, where it's so difficult to find a good stock idea. Whereas in Malaysia, I tend to find it's the opposite, right? It tends to be so easy for the simple reason that there's just nobody here. There's no competition here, and the stock prices are so low. Whereas I would say the quality of corporate management here is on par with US stocks, US companies. Definitely check out Asian Century Stocks blog. Michael Frizzle, he's the author. His coverage is mostly in the wider Asian region, but he does spend a proportionate amount of time in Malaysia. And I find myself agreeing with a lot of his ideas. They're really good. Also check out this YouTube podcast, a video podcast called The FIRL Guys. So like we mentioned just now, that's FIRL, Finance in Real Life. In contrast to many of the so-called stock market gurus, these guys actually do have some meat to the bones, right? They may not be institutional level, but they're definitely high quality retail level. So also definitely check them out. And if you want to reach out to me, just reach out to me on my LinkedIn, right? I'm free for a chat anytime. If you consider yourself true-blooded, dyed-in-the-wool value investor, I'd be happy just to be your friend and maybe have a chat with you. In fact, I've done a few over the past few weeks alone.
I love that. Aaron, thank you so much.
No, thank you, Kalani. It's been a great pleasure talking to you.
If you enjoyed this podcast episode, be sure to check out the website compoundingpodcast.com. On the website, you'll find every episode complete with transcripts, show notes, and other related resources. Either way, links to all content mentioned will be in the description below. Also be sure to sign up for my weekly newsletter, curated by Kalani, where I share what I've been reading, learning, and watching for that week. Same as the podcast, it's compressed to impress, and I aim for maximal return on your time invested. Sign up at kalanis.substack.com. So that's KALANIS.substack.com. You can also connect with me on Twitter at ScarrettKalani. But until next time, have a good one.